let's take a step back. What's the purpose of investing? Obviously, yes, it's to get wealthy, but what does that mean? Well, if you forego buying 10 hamburgers to buy an investment instead, get dividends that can buy 2 hamburgers, and when you sell the investment, the price you receive is worth 8 hamburgers, so that overall you have 10 hamburgers, you're no better off. You still have only 10 hamburgers. You may feel richer, but you won't eat richer. That's the current problem with investing in 1980. Inflation is high. Businesses have to earn more just to keep up with this inflation. Let's say your business earns 20% ROE. 20 cents for every dollar you invest in it. And inflation is 12%. Let's also say you are in the 50% tax bracket. Well, in that case, investing will actually make you poorer. Why? Okay, so you invest $100 into the business and it earns $20 because of that 20% ROE. Cool. You're in the 50% tax bracket, so you pay $10 in tax and keep the remaining $10. Inflation is 12%, so everything that cost $100 last year costs $112 this year. So you've lost $12 just to inflation, which means the whole exercise leaves you $2 worse off. Basically, inflation sucks. And on that note, let's look at why Buffett expects a pricing war from his insurance competitors. All of this inflation leads to a decrease in bond prices. Insurance companies own a lot of bonds, but the value of these bonds are shown on their balance sheets at amortized cost. Basically, this is not the current value of the bonds. In most cases, the bond prices have fallen a lot, but the amortized cost value on the balance sheet is much higher. If these bonds were shown on the balance sheet at their current market value, a lot of these insurance companies would be close to bankruptcy. Their liabilities would stay the same, yes, but their assets would fall, leading to much lower equity values. So what does all of this have to do with the price war in the insurance industry? Well, insurers will have to sell these bonds as claims come from customers. If they sell, they'll take a loss, and their balance sheets will be in trouble. But they don't have to sell the bonds anytime soon if they keep getting premiums from customers. So what do? Well, they charge lower and lower insurance premiums so they can keep getting money in. Other competitors also don't want to sell bonds, so they lower their prices too. And the result? A price war. And that is why Buffett expects one. Because of accounting rules, a lot of Berkshire's earnings don't show up on its financial statements. The insurance businesses that Berkshire owns receive insurance premiums from people. So Berkshire takes those premiums and makes a lot of investments in other companies with them. Let's say one company invests in another company. Call the company doing the investing the investor company, and the company getting invested in the investee. Well, there are rules for how the earnings that the investor company gets from the investee will be shown on the investor company's financial statements. These rules depend mostly on the percentage of the investee that the investor company buys. We'll focus on the situation where it's less than 20% because that's the case for most of Berkshire's investments. In that scenario, Berkshire, as the investor company, only shows income from its investments if the investee company pays a dividend. If it doesn't, none of the investee's income shows up on Berkshire's income statement, even though it's effectively income for Berkshire Hathaway. For example, Berkshire could buy 10% of Company X. Let's say Company X makes $100 million a year. In effect, Berkshire's investment is thus making $10 million a year. 10% of $100 million. But if Company X does not pay a dividend, then none of that $10 million shows up in Berkshire's income statement, even though effectively it is Berkshire's. And that's what's been happening. Berkshire has many investments like these where it owns less than 20%. And so as a result, a lot of its earnings don't show up on its income statement. It's like Berkshire's earnings are an iceberg. A lot of it cannot be seen, on its financial statements, but it is there. Although Berkshire basically owns that $10 million we just talked about, it doesn't have control of it. The management of Company X does. So Buffett looks for companies with management who he thinks will use retained earnings well. One use of retained earnings that he loves is when a company buys back its own shares. If a great business is selling for less than it's worth, and the company buys back some of these undervalued shares, well, then it's a win-win. Why? Well, they now get to own a higher percentage of a great business. Shareholders, that is, and they paid an undervalued price to do so through those company buybacks. Berkshire owns a lot of Geico, for example. Geico had 34 million shares outstanding last year in 1979. It's been buying back so many of its own shares that they are now, in 1980, just 22 million shares outstanding. So Buffett and Berkshire now own a much bigger portion of the company as a result. Well, let's look at how Berkshire's doing in 1980. Return on equity capital fell from 18.6% last year to 17.8% this year. This is the most appropriate measure of a company's single-year performance. And in the 16 years that Buffett has owned Berkshire, that is since 1964, its book value per share, which you can look at as kind of a rough measure of the company's value per share, that has increased from $19.46 in 1964 to $400 in 1980. That's 20.5% compounded annually. Finally, Berkshire borrowed $60 million this year by selling some bonds. But this was done because Buffett and Munger believe they will find many opportunities to put the borrowed money to use. Hopefully, we see some of that in 1981.